Everybody, welcome to the new episode of Finance Pe Charcha. We have a new guest today, but I hope you've been watching this series and been learning from the market participants that we have for you on this show. Lately, if you've observed, IT has been around in discussion for quite some time now. From whatever's been happening or was happening in the US, where the NASDAQ fell down so much, in India, IT stocks hitting 25-30% lower, and suddenly at the time of the recording, IT is at 52 weeks high in India. It's been doing rounds around as to, is it the right time to invest with interest rates going down in the US, dollar moving around at 52-week high? Should you invest more money in IT or pull money off the table? We have today Meeta with us, going to help us understand how the IT sector moves and what to look for in the IT stock. To give you a little background, Meeta actually runs Tata Digital Fund, one of our recommended funds that we suggest. Meeta has been around at HDFC and Kotak in the past. She manages 3 funds at Tata. And my prime reason of inviting her was because Tata Digital is a part of our recommended fund. And because we recommend it, why not have somebody like her to talk about IT as a sector, because we've been following her investment strategy for quite some time, and I'm sure she is going to be able to help us understand the IT sector much better. Hi, Meeta.
Hi, Kirtan. Thank you so much for inviting me. Pleasure being here.
I am so glad that you took the time out to be a part of this show amidst the result season in IT. So thank you so much.
Sure. Thanks.
Meeta, like I said in my introduction, I know IT's been all over the place over the last one year. You've surely observed that in the fund flow in your Tata Digital Fund, because you know how retail is, right? Or even the distributor community. Largely, a lot of money flows in when the fund starts performing, and I'm sure with the IT sector hitting the 52-week high in India, there is a lot of buoyancy in IT. So while I'm sure you know what you want to talk to us about IT, would love to hear your views on whether these are the right times and a good valuation to invest in IT at this point in time, and all of that amongst whatever you've already prepared for us. So thank you so much for taking the time out, Meeta. I'll just share the screen rights with you so that you can help us with what you've prepared. Just give me a moment.
Sure. All right. So first of all, good afternoon, everyone. And thank you, Kirtan, for getting us this opportunity. And it's always a pleasure to connect to the entire channel partners, the distributor community, and of course, your stakeholders. So as Kirtan has already indicated that we will be discussing about the IT sector and, the fund that I manage here at Tata's. So what I have thought is that first few slides is just about understanding the sector basics. So, when we talk about digital, digital is something which has a very wide area. I mean, it covers a lot of things. So I've just tried to, silo them into 2 different buckets. One would be your digital change agents, and the other would be enablers. So when I say change agents, basically we are talking about all the apps or the way we now transact with say ordering food or hiring a cab, etc. So it's basically the platformization of the services which we have been doing for about decades and donkey's years. So everything between an Amazon or a Myntra shopping or an Uber Ola app or a Paytm or even your banking apps, etc. All of that are basically categorized here as digital change agents. And the second bucket is the enablers. Enablers is basically the the erstwhile names of the IT industry for India, which is TCS, Infosys, Wipro, etc. Now, why are we saying or calling them enablers? Basically, what we're trying to say is that these companies are the services companies, and they enable the change that a large enterprise or a bank or any large setup would want to go forward to. So that transformation could be cloud transformation, could be an automation, could be a robotic process automation, or an Internet of Things. Basically, just walking towards a newer technology is what these IT companies in India enable the large enterprises for. So we are not providers of that technology. So for example, when I say cloud, now there are three major cloud providers in the world, like an Amazon or a Google cloud provider or a Microsoft Azure. But we don't provide that. We are just enablers. We just help and make the clients or the enterprises walk that journey from a non-cloud enterprise to a cloud enterprise. So that's what we do. Basically, we are just enablers for transforming into a more digitized world. So these are the two buckets. Now, when I look at Indian listed companies in the IT space, a large part of that actually is towards the enablers, and hence good part of my conversation today would also be towards enablers, because when I'm looking to invest into my fund, when I'm evaluating companies, a good part of my companies actually fall into the enablers bucket. Of course, we do have some change agents now listed into the Indian Indian listed entities, but they're not so much yet, and we're still seeing that evolve over a period. I'm sure in the next 5-10 years we'll have a lot more of those change agents actually listed on the bourses. So right now, today for the discussion per se, we will be talking more on the enabler side, but anything that Kirtan wants to discuss on the change agents, we'll be happy to do so. So when I'm talking about
Meeta, so do I understand this correct? Which is why we called our IT companies as more service and not product, because we don't make those platforms, right? We are only service provider, trying to smoothen the process for whoever wants to use that cloud platform. Do I have that correct?
Smoothen and also walk them through that journey. Basically, we will help them move that data from an old technology to a new technology, say move them towards cloud, and then also managing it over a cloud, do a cloud computing, enable IoT on that, enable AI on that. So basically, that's what we do. So we are enablers. Yeah. Okay. So we will be talking more about enablers today, because that's where a large part of the listed entities are part of the enablers. So if I look at the Indian IT export, roughly we have close to about $200 billion number now as we come to FY23, actually slightly above $200 billion. But the chart will actually tell you where the revenue actually is coming from. When I'm talking about geography breakup, US is of course the largest with about almost 60% plus kind of contribution. UK, Europe put together is roughly about 25-30 odd percentage.
So also, if you could use the cursor, I'll know what part of the presentation
Sure. So this is what we are talking, right? So the geography breakup is what basically is telling you as to our services revenues, basically your TCS or an Infosys, where are they earning large part of the revenue? This is India level data. Company specific might be slightly different, but large part of companies also have something similar. So you can see that US is obviously largest at about 60 odd percentage. Then UK, Europe put together is about 27 odd percentage. And the rest are obviously more fragmented. When I talk about industries or verticals, as we call in the Indian IT context, so BFSI is obviously the largest with about 41 odd percentage contribution. Then you would see manufacturing and high tech, which are about in 16 to 18 kind of band. Retail and healthcare and the others are all fragmented numbers, but largely BFSI is something that really is the biggest and biggest driver for the IT services company. So anything happening in the US, like what we saw during GFC, IT stocks actually collapsed because banking industry was into a very bad shape. So even right now, when we're talking about interest rates going up and banking spends kind of getting reevaluated, and companies or the banks are still thinking whether to go ahead with large spends. That's what we saw in the in the stocks as well over the last 1 year. So anything on the BFSI, negative or positive, that usually has a very volatile impact on the IT stocks as well. So US and BFSI are very, very critical when it comes to the IT industry. Now, I have given a table over here, which is giving you the growth rates of the Indian IT exports, and the absolute number as well is given there in the bold. You can see it's very interesting that FY 9 and 10. So FY 10 is where we actually saw the growth rates dipping to almost 5 odd percentage. Prior to that, the industry was growing in a very healthy double-digit number. So that was around GFC, the post-GFC impact, which we actually saw. FY 10 for us is obviously ending, March 2010. So GFC happened around end of 2008, and 2009 was the year where a lot of that brunt was taken. And hence FY 10 number is what is looking very weak. Post that, we saw a very sharp bounce back. So we saw the growth rates actually jumping to closer to 20% and then holding up to about that 16-17% range. But interestingly, from FY 13 to all the way up to FY 20, you can see that growth rates continuously dropped every year. And in fact, from 17 to 20, the growth rates were in a very very narrow range of about 8 odd percentage. So these growth rates actually, were in that range for a pretty long time. And only in the COVID year, we saw that jumping all the way up to almost 20%. So that is how the growth rates of the Indian IT industry has panned out over the last few years.
So ideally, I mean, I may be wrong, but I'm just taking a cue from what you presented. There is a lag effect of at least a year, 12 to 18 months for that effect to actually show up on the growth numbers, right?
So what happens, yeah, that's very interesting actually, Kirtan. What happens usually is that, whatever deal is already in the execution phase, there is generally not, companies won't pause that because it's already halfway or probably it's on the roll. But whatever is getting signed for the next year is where a lot of cuts starts happening. And that's why we see that kind of impact. So interestingly, see, we've seen the interest rates going up in the US since Jan, Feb of last year. And we haven't seen the revenue impact. We hadn't seen the revenue impact in 2022 calendar year. We actually started seeing it only now. Because whatever was already getting executed, there was absolutely no impact because of that. But deal win numbers or, the deal signings are now starting to show up in that.
Interesting. Thank you.
Yeah.
Interesting.
So because BFSI is extremely important, I just thought that, this chart would make a lot of sense. So this is the top 5, BFSI clients or BFS clients actually in the US. And this is a trajectory as to how they have increased their IT spends as percentage of revenue and in absolute terms. So you can see that from about 6.5% or 6% of revenues has actually gone up to all the way up to 8% of revenues. And this is all happening because of, more digitization, banks having more application, lot of spends on digital basically. Today, we also as consumers, we don't go to our banks now. We hardly step into the branches like how our parents used to do practically every month or every week. So all of that change is what is driving this kind of increase, not only in India, but of course, everywhere in the world. And this is what is keeping the interest high for the Indian ITs, because as I said, BFSI is one of the most critical sectors when it comes to spends. So this number is looking pretty strong. Obviously, if I look at the very near quarter, it's more plateauing, but the commentary is still holding up pretty well.
Sure.
So that was how the contours of the Indian IT industries was, services industry was, and now is up to the growth drivers. So how does Indian IT industry grow? Obviously, one is that the world budgets, like what we saw, the banking industry was increasing their budgets, and that obviously will come our way. And second interesting point is the market share gains. So we have seen over a longer period, if I have to, So this is a chart which is showing how we have, incrementally been inching higher and higher when it comes to our market shares. You can see that from FY 11 to FY 22, we have nearly added almost 10 basis points of market share when it comes to the Indian IT. Now, this data is more about top companies. When I look at the overall industry, this number may be a little off, but I've just plotted 10 companies in the US and about top tier ones in the Indian context, and how their revenue pie has moved. So we have been always incrementally gaining more market share with time. And that adds a leg up to our growth levels versus the overall IT spend growth in the world. So if you look at the IT spend growth in the world, this is how the number has been. So if you recall the table which I showed you earlier, in 2010-11, we were growing in 11 and 12 was a bounce back year, and then we were growing at about 8 odd percentage. But you can see that the world market growth rates has been in the range of 4 to 5%. So we have been incrementally growing higher, and part of the reason, of course, is the market share gains which we have been regularly seeing. The 19% growth that we saw in the pandemic year, world budget was up almost 14%. And the interesting point here is that if you look at the growth rates for the next 3 years, which Gartner is predicting, that is possibly going to be higher than what we have seen in the pre-pandemic years, which is very, very interesting, because that means that, whatever we saw as a pent up in the pandemic is obviously not going to sustain, but we are not going down all the way to that 4-5% growth rates in the world IT budgets. We probably will settle at a much higher number. Now let's see how this pans out, but at least the indications are so by large market research.
Going by the data that we see historically, if the prediction is that we are going to grow between or IT spends are going to be around 8.5, I think, are we saying that we'll grow at 10-11% because we will get a higher market share?
That's what is the thought, actually. Yeah. So we are not going back to 8, what we were for FY 17 to 20. We're probably settling at somewhere close to 10.
So largely, if I have to just concise for the viewers so far, what we are saying is that because export is the major business for an IT company, we are extremely linked to what happens to markets globally.
Yeah.
Right. And because banking and financial services holds 40% of the total business that the IT company actually makes as a vertical, financial services, and specifically in the US, because that accounts for 60%, is an extremely important data point, because that will largely drive whether as an IT company, do I get more business or less business, right?
Absolutely. Absolutely. Absolutely.
Awesome. Got you. Thank you.
Okay. So I get a lot of questions as to whether we benefit from INR. So yes, on the revenue line item, it might look so because, when we see that in rupee terms, yes, it does. But that's why companies generally report CC growth. So they also give you a constant currency growth number, wherein if the currency was stable, or say you take the same base, then what the growth rates will look like. So this is not so relevant, but because I always keep getting this question, I put it here. In my sense, always the benefit of the rupee depreciation is somewhere, adjusted in terms of the pricing and the contracts that we keep getting. But yes, in rupee terms, it might look like we have actually grown higher. But in dollar term is what I think one should actually focus on, and not the rupee number.
So Meeta, do I understand this correct? When these IT companies come out and say that we've grown at an X rate in constant currency term, largely what they are trying to say is that forget about the rupee increment and decrement, right? Had the currency been constant and not moved at all, then our growth rate would have been this much.
That's what it is. Yes, that's what it is.
So basically what we are trying to say is you always look at the constant currency growth rate of an IT company to understand whether the IT company is growing or not.
Yeah.
The increase and decrease in the rupee or other currency is not really adding any value as such on a macro level, right?
That's right. That's right. Because then you would never know the actual picture as to where the revenue growth is. So constant currency is what is extremely relevant when we are looking at the growth rates of the IT companies.
But you also mentioned that while you are while there may be an advantage on the revenue line item when the rupee is depreciating, but it is not really creating any big impact in terms of valuation for an IT company. So it is not that because the dollar is going up, IT stocks should go up because I will make more money because the rupee is depreciating.
So I put it this way. So what I have seen in the last so many years that I have covering this sector and managing this one, I have seen that we generally see if the depreciation or the appreciation, either ways, happens very swiftly within a very short span of time, say a month or two, then some bit of that, volatility we also see in the stock prices, because if it's a gain or impact, it starts reflecting in the EBIT or the margin number, because your cost out of your total employee cost, 60-65% of the cost is also dollar denominated, and the remaining is local currency. So some bit of that starts playing, but it's only if it happens in a very short cycle. Over a 3 months, 6 months, a year, if it happens gradually, most of the pricing also kind of adjusts to, I mean, clients will also know, right? You're making extra buck because of the currency benefits or the pack. So that kind of then gets negated, and plus your salary increases will also somewhere compensate for that. So I think at a medium to long term level, what you're saying is very right. If it happens in a month or two, you might see some volatility in the stock driven by this, but it's very short term.
Meeta, allow me to kind of try and simplify this a little for the viewers,
Sure.
because they might not really understand the discussion you and I are having. And correct me if I'm saying what I'm saying is correct, right? So guys, what we are discussing is, let's say $1 is 80 rupees, right? So the IT company, for every $1 of billing, is expecting 80 rupees to come in. But suddenly if $1 becomes 90, right? The IT company will still receive the $1 from the contract, but instead of getting 80, the IT company will receive 90 rupees, which is much higher than what the IT company actually expected. And which is why the conversation I and Meeta are having, that, if the rupee depreciates from $1.80 to $1.90, should the stock price positively react? Because instead of 80, they are receiving 90. So Meeta very interestingly mentioned that, look, the cost of an IT company is also 60% in dollar terms, right? So it is not that the entire depreciation of rupee from 80 to 90 is an income to the IT company. So if it happens very swiftly, as a 5-10 दिन में currency move हो गया, then you might see technically the IT stocks reacting. But she's saying that if you put this across, or the depreciation is happening over 3 months, 6 months, 9 months, 12 months, then suddenly the one who's giving you business also knows that you are making more money if the rupee depreciate. So they reduce the pricing from $1 to 0.9 to kind of come back to the same level, right? So Meeta, I hope I was correct in saying what I just mentioned, right?
Bang on, Kirtan.
Okay, perfect. Thank you so much. This is very interesting.
Sure. So I've covered the broader contours of the industry, and on the cost line item, we have to just touch base. We just discussed the employee cost. That's one of the most critical number to keep an eye on, and that's like, because gross margin or say the employee cost, then whatever is left is basically the gross margin for IT companies, and that number is extremely critical. And then obviously that's how it derives your EBIT margin, etc. Now, broadly coming to the valuation part, because I think that is a very interesting, chart, and I thought that I should highlight this. This is how the IT 1 year forward BSE IT PE ratio looks like. And you can see that I have also given you the average of Sensex, versus the broader market, you can say. And this is the premium to BSE IT versus Nifty or Sensex. You can see that how this has moved over a longer, say a 20-year or a 15-year average. This has this sector has always traded at about 10% premium. And you can see that during the COVID,
if you can use the cursor, please.
Yeah. Is this better? Okay.
Yeah.
So you can see that the gray line here, that is giving you the long-term average, which is at about 10% and multiple times sector has also traded at much below. So in 2017-18, we saw that sector was actually trading at about 15 to 20% discount to the overall markets. And we also had times like pandemic where the sector was actually trading at 30-40% premium to the overall markets. So the sector has swung, very a lot, I would say, on a relative basis. And the interesting point is that now, if we look at the sector valuations versus the broader markets, we have just, if I have to remove this last 5 days uptick, we were almost at the 10% average of to the broader markets. So we were almost at the gray line. The uptick in the last 4-5 days is what is showing, getting captured here. So this is how the sector has moved on a relative basis to the broader markets. And this is This is just to show you as to how volatile the sector has been over the last 4-5 years, going all the way from a 10% discount to a 40-50% premium, and now back to about 10% premium.
I'm going to ask you a very tricky question. I'm not sure if this is the right platform, but I really wanted to ask this to somebody who really understands this. So I was reading a commentary. I don't remember whose commentary that was, but it said that in banks with a 30% improvement in profits, that only translates to 10% in valuations. But in IT, it's the complete opposite, right? आपका 10% से PAT improve हो जाता है, उसका 30% impact आ जाता है आपके valuation पे, right? So how do you look at it? I mean, is the market fairly valuing IT companies at this point in time? Because it was exuberant during 2020 pandemic, right? Where everybody, you and me, thought that there is nothing going to be physical, everybody is going to go digital. And that's the kind of valuation that the IT companies were trading at. And now I think you've very rightly pointed out that currently you remove the last 5 days rally and we are close to historical averages of 10% premium to the market. Not sure if it's the right question to ask you and whether you are in a position to answer it for various regulatory reasons. But even at these levels, right, are IT companies fairly priced? I mean, let's say if I really want to take a bet from a 3-year perspective at the current valuations, your chart shows that we are trading at a 10%, which is historically the average. But do I take a plunge at these times?
So I can share whatever I will be able to, but let me see what justice I can do. So I think that there are 2-3 things that I look at when I'm looking at not only this, but any other sector. One is obviously this chart, which shows you that how we are in a relative sense. The other interesting point, particularly for IT stocks, which I keep a close watch, is that the free cash flow yield. So this sector usually, has been growing a lot of cash flows. They generate a lot of free cash flow. And versus to their market cap, what is that percentage that their free cash flow is today? The range for this sector usually is between 1.5-2% to all the way up to 5%. The higher the market cap or the costlier or the expensive the stocks, the yield will look obviously lower at about 1.5-2%. And the more comfortable zones are obviously between 3-4%. If it's a 5, then I think we probably are somewhere close to here, where we were in 17, right? So that's like the most comfortable zone. So I think when I look at that number today, I think the sector is somewhere close to 3-3.5%. So it's also a comfortable range. It's not. So when we were over here, we were at about 1.5%. So right. So it's nothing but looking at the same chart in a different way. But that also gives you a comfort that on free cash flow yield, it's again in a range where we are pretty comfortable. So at least we can say that from a 3-4 year perspective, if the growth rates which Gartner was highlighting, and then how Indian IT incrementally would add some more basis points of growth to it. That's how the growth, if it's going to pan out, and if this is the valuation and the free cash flow yield, then from a 3-4 year perspective, 5-year perspective, I think the sector looks good in terms of growth, I would say.
Again, I'm just trying to simplify for the audience. So we are saying that Infosys free cash flow is, let's say, $100, but Infosys is trading at probably $3,000, or the market capitalization of Infosys is 3,000. So I'm saying 100 rupees of free cash flow divided by 3,000 of market cap. I'm saying that the yield is roughly around 3%, and the range is 1.5% to 5%. Where 5%, if you get somebody at a 5% yield, it's a brilliant buy, right? And the closer it is to 1.5-2%, it's slightly expensive in that sense. And you currently see that the market is roughly at 3.5. So we are at the midpoint and we are not exuberantly higher or lower, right?
Just one thing. So this is more industry data. There will be some stocks which will probably at 5-6% also.
Oh, yeah, absolutely.
Yeah.
Absolutely.
So
I mean, that's where you generate your alpha from, right?
yeah. And that's not the only number to look at, because you have to also see the context of what is the ROE, ROC, because there might be companies who might be always available at 5-6% free cash flow, because they may not be very great in terms of the business.
Super. So Mita, can you give us 5-6 things that I should look at if I'm evaluating an IT company? How do I decide whether I don't want you to name any IT stock, but give me 4-5 things that I can look at to decide whether or not this company is good for me to take a plunge.
Okay, so so let's look at first the profit and loss statement, which your or revenue, EBITDA, that. So on the revenue line item, I think revenue number is what most of us know, and it's very easily available. But book to bill basically is the order book to your revenue number. That number generally gives some visibility in terms of growth going ahead. So whatever your order book is, generally 1.4, 1.5 is what we are currently trending at. If it goes down to 1 or 1.1, 1.2, then you might see that probably there's not enough deals for you to base your projections on or have a visibility on.
Can you take some numbers just for explanation purpose? How did you come at 1.4, 1.2?
Yeah, sure. So for example, now $1 billion is the revenue for, say, a company A. And on a quarterly basis, the company has been showing a deal win number of, say, $250 million for the last 4 quarters. So your trailing last 4 quarters is again adding up to $1 billion, and your revenue is also $1 billion. So your book to bill is only 1. Basically, so assuming that all these $250 million deal is executable over the next 1 year, then you are going to be probably at the same range in terms of revenue. 1 billion for FY23, 1 billion for FY24. There's no growth. Very layman. I mean, there are nuances.
No, but this is what we want. Yeah.
There are a lot of nuances to it, but this is a very basic thing. If the book to bill, or say the order book, adds up to $1.5 billion, then your book to bill is also 50% higher than your existing revenue. So 1.5x is your book to bill. So for a $2 billion company, if the last 4 trailing quarter deal win number is 3, then your book to bill is again 1.5. So basically, it gives you some visibility in terms of growth, but there are a lot of nuances to it. There can be deals which might be over a 10-year period and not necessarily a year or 2 year. So yeah, but this is some number to look at.
Which is why IT stocks also react when these new news reports come out that they've got another order or they've signed a...
Absolutely. Yeah. So in FY22, there was a quarter when Infi, from an average of $1.5 billion deal that they used to announce, they announced a $7 billion deal with, and the stock just zoomed up. So yeah, deal win numbers are something to look at, which gives you...
That's one point.
Yeah. Second is your gross margin and your subcontractor cost. That's basically your employee cost, both put together. Subcontractors are not your on-roll employees. They are your subcontractors, which you hire to fulfill a certain project for a short period of time. Most of these subcontractors usually sit out of, on-site locations like US, Europe, wherever your client is, basically. And that swings very quickly, the subcontractor, most of the times. And it gives you a good... So if the subcontractor cost is zoomed up in a quarter from, say, 10% of sales to, say, 13% of sales, then you know that, it is going to impact for some time, but it probably can also be a lever at some point for margin expansions going into future. So that's there. Then is your OCF to your EBITDA to OCF. Basically, what amount of your EBITDA is actually landing as a operating cash flow, or your PAT number to your free cash flow. So is your entire PAT going as a free cash flow? Sometimes the number is even higher than 100%. But so that gives you that whether the business, you're only not getting revenues and making margins, but your working capital is also extremely tight and improving. So that gives you some additional comfort if it's getting better with time. Then would be, of course, your free cash flow yield, which I've already explained. And then would be your PE ratio, or the relative number that we're just staring at. So these are the few basic points to keep in mind when we're looking at IT sector.
Interesting. Will you also consider a company doing well if they are hiring more every quarter? Because lately media highlights a lot of attrition and new hiree data.
Yeah.
while they report results.
Yeah. So, Kirtan, if you look at the sector, right, it is very interesting to see that the sector has gone through its own cycle in terms of employee hiring as well. There used to be a time before FY 15, 16 where always you will have a bench, meaning you will have employees which are actually not actually on a project, they're still on your role. And that bench will be there, and as and when deal comes up, you already have a ready pool to kind of get deployed on that particular deal or a project. So that was the industry norm at some point. As we went into FY 18, 17, 18 and beyond, we saw that the bench culture was not there. And most of the companies will only hire when they have that kind of visibility on revenue. So when the pandemic hit, there was a rush to just keep hiring because there was so much work coming our way. Like you saw, the growth rates went up from about 8% to 20%. That much of work coming our way, and there was absolutely no bench for most of the companies. There was no, usual practice of having a bench at that point. And we saw that flush of hiring happening at practically every company added 20, 30%, some even 50, 60% to their existing pool in that short 1.5 year time frame. And then you saw that attrition numbers also were hitting the roof during the pandemic times because everyone was trying to poach each other's employee or talent in that scenario. Today, the things are very different. Companies don't want to hire. They already feel that they've overhired in the pandemic time. And now they want to first ensure that they utilize the strength that they have currently. They're also letting go of some high, salaried employees or the laterals as we call, and they're trying to improve their pyramid. Now, pyramid is a very coined word. I mean, we usually keep hearing managements talking about it. So if I have to just explain that in a very basic term, pyramid is nothing, but basically it's actually a pyramid where the bottom layer is your 1 to 2 year, experienced guys. And then as you go up the pyramid, obviously you have the laterals and the extremely 15 plus years experience, 20 plus years experience sitting right at the top. So the flatter it is, that means your lowest 1 to 2 year is higher in terms of your employee strength, much more higher than the narrower pyramid would. And that's the best cost structure because then you're not paying so much to the bottom, and your laterals are also narrow. So the flatter the pyramid, the better it is. So that's what companies are now trying to do. They want to become more flatter, and they're not hiring, they're letting go of laterals, and which is helping them make the pyramid more flatter. So yeah, to your question, hiring number was very relevant in the pandemic times because that was giving us some sense that, okay, if this company is adding 20% to its base, that's the visibility they have. But today, hiring number does not give you any clue because they're actually not into a very hiring spree as they were.
Correct. Very interesting, Mita. Very interesting. Mita, if you allow me to just recap in 2 minutes of what we've covered so far, and correct me if I've been able to gather this learning from your talk.
Sure.
So we largely said that IT companies make most of their money by exports. Geographically, US is the largest, where there is 65% worth of business allocated, which comes from the US. From a sectorial standpoint, close to 40% is banking and financial services, BFS, which is why anything happens to banks in the US, that has a large impact on India IT stocks, right? We said while the valuations move up and down very aggressively, but currently we are very close to the long-term average of 10% premium of where the larger markets are in India, and hence valuations are not aggressive at this point in time, is what I could gather from your talks. Also, you made a very interesting point of some 4 or 5 things that you typically look at before. Of course, these are very macro points, and there are 100 other things that you would look at. But you very interestingly made a comment around how you look at what the free cash flow of the company versus the market cap, right? You said probably 3.5, 4, 5 are some very interesting areas to look at. You also made a mention of how you really look at the bill to the revenue ratio, Do I have the name correct? Bill to the revenue ratio, book to bill ratio, right? That you look at. You also look at how PAT is actually converting into a free cash flow, or your EBITDA is converting into an operating cash flow. That's an interesting data that you looked at. You also very interestingly mentioned of gross margins and how those gross margins are extremely linked, and the industry is changing, where there were a lot of people on the bench, and now because they've hired so much, now actually hiring is not a very great number to look at, which actually was during 2020, because that gave a predictive data point of how much business is this industry expecting. But gross margin is definitely something that has to be looked at. And you very interestingly defunct this idea of how rupee depreciation is not really adding a lot of value to revenue numbers over a long term in an IT company. It might definitely work out in your favor if those numbers are the currency is getting appreciated or depreciated in the near term, and it might reflect in the stock price, but it does not change a lot of things on the financial statements, right? These are my takeaways, and I can very categorically tell you that I've learned so much from today's presentation, right? And I must tell you that I keep talking to a lot of fund managers, so to say, but there are very few who can simplify things. And I am so glad that I have you on the show, and you simplified it so easily for us that I could understand, and I'm sure everybody viewing this would have definitely understood what you actually tried conveying to us in this presentation. So Meeta, thank you so much for keeping it so laymanish, if I don't know if that's even a word, but to keeping it so simple for us that we actually understood what to look for in an IT stock, and whether or not is there a bubble building up, and what actually happened in terms of valuations. Meeta, I would only want to thank you again for taking the time out and being a part of this presentation and making such a complicated subject so simple for us to understand.
Thank you so much, Kirtan. Thank you for all the kind words, and I hope our stakeholders also benefit the most from this session. Thank you so much.